As Halloween approaches, the crypto community is marking an important milestone, the 16th anniversary of Satoshi Nakamoto's iconic Bitcoin whitepaper. This groundbreaking document, first released on October 31st, 2008, laid the foundation for Bitcoin, the world's first decentralized digital currency, and the broader cryptocurrency ecosystem we know today. Celebrating its sweet 16, this anniversary signifies more than just the passage of time. It underscores how far blockchain technology and the crypto industry have come since those early days. The influence of Nakamoto's vision has since reshaped global financial systems, ushering in a new era of digital assets, decentralized finance or DeFi, and tokenized economies. To commemorate this milestone, today's video dives into 5 critical crypto news stories, each reflecting the ongoing evolution of the crypto world and its relationship with regulation, financial markets, and institutional adoption. The world of cryptocurrency is growing at an accelerating pace, with its influence expanding across diverse sectors from fintech to traditional finance. However, it faces unique challenges in navigating regulatory landscapes, particularly in the United States, where the Securities and Exchange Commission and other regulatory bodies have taken a hardline approach to ensuring compliance with existing securities laws. The following segments will explore these challenges, as well as the efforts from industry players like Ripple and prominent figures such as Michael Saylor. By the end of this discussion, it will be clear just how pivotal regulation, market competition, and global leadership will be in shaping the future of cryptocurrency. SEC Chair Gary Gensler's stance, regulation, and Bitcoin's place in the financial system. A major point of debate within the cryptocurrency space is how governments and regulators, particularly the SEC in the United States, should oversee digital assets. In this context, current SEC Chair Gary Gensler has been a controversial figure. Known for his stringent regulatory stance, Gensler recently made headlines by reaffirming his belief that Bitcoin and other blockchain-based technologies can operate within existing securities laws. Despite pushback from various political and industry factions calling for updated regulatory frameworks, Gensler has maintained that the Securities Act, established decades ago, can sufficiently govern the crypto space without the need for significant legislative overhauls. During a recent interview with Bloomberg, Gensler was pressed on whether there's a consensus for modernizing crypto regulations. He responded by suggesting that there's no fundamental conflict between decentralized ledger technology, like Bitcoin, and the securities laws already in place. He emphasized the importance of investor protection, arguing that while blockchain technology offers tremendous potential, it also presents risks to investors, especially in terms of market manipulation and fraud. Gensler pointed out that many cryptocurrency projects operate in regulatory gray areas, failing to disclose necessary information about their operations and posing conflicts of interest. These concerns, he argues, need to be addressed if the crypto market is ever to gain the trust and confidence of the broader public. While many in the crypto industry advocate for clearer, crypto-specific regulatory frameworks, Gensler's position underscores a more conservative approach. Apply the laws as they are, regardless of how disruptive the underlying technology may be. This stance has drawn criticism, particularly as the United States faces pressure from international competitors who are advancing with more crypto-friendly policies. Nevertheless, Gensler insists that proper disclosure and compliance are non-negotiable pillars of a functioning and trustworthy financial system. The US is falling behind in crypto regulation. While Gary Gensler defends the SEC's approach, others in the regulatory space believe that the US is not keeping pace with the rapid growth of the crypto industry. One such voice is former FDIC Chair Juliana Williams, who has been vocal about her concerns regarding the US falling behind its global counterparts in terms of cryptocurrency regulation. According to Williams, countries like the UK, Singapore, Japan, and Switzerland have already implemented more progressive regulatory frameworks, making their markets more appealing for crypto innovation and investment. Williams has called on US lawmakers to pass comprehensive legislation, starting with stable coins, which she views as the lowest hanging fruit in terms of regulatory oversight. Stable coins, which are digital assets pegged to traditional currencies like the US dollar, have become a cornerstone of the crypto economy, facilitating everything from trading to cross-border payments. However, without clear legal guidelines, these assets could pose systemic risks, particularly in terms of liquidity and stability. Williams argues that Congress needs to act swiftly to ensure that stablecoins are properly regulated before their use becomes too widespread to manage effectively. In her remarks, Williams also took aim at Gary Gensler, suggesting that his leadership has failed to address the unique challenges posed by the crypto market. She emphasized that the United States, historically a leader in financial innovation, is now at risk of being left behind as other countries embrace digital currencies with more clarity and foresight. For Williams, the solution is not to rely on outdated securities laws, but to create new rules that recognize the distinct nature of digital assets. She believes that bipartisan efforts in Congress, particularly around stablecoins, could pave the way for a more comprehensive regulatory approach to cryptocurrencies, benefiting both the industry and everyday investors. Ripple CEO Brad Garlinghouse. Optimism for fair crypto regulations in 2024. As debates around crypto regulation continue, Ripple CEO Brad Garlinghouse has expressed optimism that fair regulations are on the horizon, regardless of which political party wins the 2024 United States presidential election. Garlinghouse, whose company Ripple has been entangled in a legal battle with the SEC over its XRP token, believes that the upcoming election could bring a much-needed reset in how the United States government approaches cryptocurrency. Garlinghouse noted that in recent years, Republicans have generally been more proactive in supporting clear regulations for the crypto industry. In particular, he pointed to bipartisan support for a crypto regulatory bill in the House, which saw over 70 Democrats cross the aisle to vote in favor of the legislation. This, Garlinghouse argues, shows that there is growing recognition across the political spectrum that the crypto industry needs regulatory clarity to thrive. He also mentioned that the Kamala Harris campaign has signaled interest in revisiting some of the Biden administration's policies toward technology and cryptocurrency, which could lead to more favorable conditions for the industry. Despite the ongoing legal challenges Ripple faces, Garlinghouse remains hopeful that the United States will eventually catch up to countries like the UK, Japan, and Switzerland, all of which have already established clear regulatory frameworks for digital assets. He believes that once the United States government recognizes the importance of crypto innovation and sets appropriate regulations, the industry will be able to grow in a more secure and sustainable manner. Garlinghouse's optimism stems from his view that both political parties are starting to see the value in crypto, not just as an investment, but as a driver of technological innovation and financial inclusion. Michael Saylor controversy: self-custody versus institutional Bitcoin holdings. In a recent controversy, prominent Bitcoin advocate Michael Saylor found himself at odds with parts of the Bitcoin community over comments he made about self-custody. During a podcast appearance, Saylor suggested that Bitcoin might be safer when held by institutional custodians rather than individual holders, drawing parallels to the gold confiscation in the United States during the Great Depression. Saylor's remarks sparked outrage among Bitcoin maximalists who believe that one of Bitcoin's core tenets is the ability for individuals to hold and control their assets without relying on third parties. The backlash was swift, with many in the crypto community accusing Saylor of downplaying the importance of self-sovereignty in the Bitcoin ecosystem. Bitcoin enthusiasts have long advocated for self-custody, the practice of personally holding one's Bitcoin in a private wallet, as a way to protect against government interference, seizure, and the risks associated with centralized financial institutions. In response to the criticism, Saylor quickly backtracked, releasing several statements on social media affirming his belief in the importance of self-custody. He clarified that while institutional custody plays a role in bringing Bitcoin into the mainstream, self-custody remains a crucial aspect of the Bitcoin ethos. This incident highlighted the tension between the desire for Bitcoin to be adopted by traditional financial institutions and the need to preserve the decentralized nature of the cryptocurrency. For many Bitcoiners, self-custody is not just an option. It's a fundamental right and a safeguard against potential overreach by governments or corporations. Bitcoin versus gold, the fight for market share and store of value. Bitcoin's growing prominence as a store of value has led to increased competition with traditional assets like gold. According to ETF expert Eric Balchunas, Bitcoin has steadily been taking market share away from gold throughout 2024, a trend that has only been accelerated by the introduction of Bitcoin exchange-traded funds, or ETFs. While gold has had a strong year in terms of price performance, it has struggled to attract the same level of investment as Bitcoin, particularly from younger investors who see digital assets as the future of money. Balchunas noted that gold saw modest inflows throughout the year, but Bitcoin ETFs have dominated, drawing in over $21 billion in investments. This shift, he argues, suggests that Bitcoin is increasingly being seen as a legitimate alternative to gold as a store of value. For decades, gold has been the go-to asset for investors looking to hedge against inflation and economic uncertainty. However, Bitcoin's limited supply and growing institutional acceptance are positioning it as a viable competitor in this space. This competition between Bitcoin and gold reflects a broader generational shift in how investors approach wealth preservation. While older generations may still view gold as the safest asset, younger investors are more likely to trust in the technological underpinnings of Bitcoin and its potential to outpace traditional assets in the long term. Balchunas predicts that this trend will continue, especially as more Bitcoin ETFs are approved and as the broader market recognizes the benefits of digital assets over physical commodities like gold. As the year draws to a close, the outlook for cryptocurrency remains bullish, with many industry experts predicting that 2025 could be a breakthrough year for digital assets. The increasing institutional adoption of Bitcoin, the growing regulatory clarity around stablecoins and other cryptocurrencies, and the continued development of blockchain technology all point toward a strong future for the crypto industry. The script ends by encouraging viewers to stay informed and engaged with the crypto space, reminding them that the next few years will be critical for both investors and innovators. With so much potential for growth and change on the horizon, staying up to date with the latest news and developments will be essential for anyone looking to participate in the next phase of the crypto revolution.